So how could the economy and markets hold up amid elevated energy prices? Joining us now is Gargi Chaudhuri. She is BlackRock's Chief Investment and Portfolio Strategist for the Americas. Gargi, great to have you with us.
It's wonderful to be here.
It seems like the consumer is largely held up, but are we getting to a point where you're getting concerned?
So we just published our advisor outlook, and one of the themes that we point out in this monthly piece is the resilience of the U.S. economic data. Now, whether that is evident in the job market data that we saw on Friday, retail sales, we haven't really seen the impact of higher energy prices feed through yet into the consumer. Now, obviously, I use the word yet because that is something that we're going to be watching out for, including in the transmission mechanism to core inflation, which ultimately is what's going to determine the next step for policy as well for markets.
It seems the market has been able to perhaps look beyond some of the risks that there is an inflationary surge or that the consumer is going to be hurt, mainly because there is this CapEx cycle that is creating so much value in the near term. So as an investor, as an advisor, how do you deal with the possibility that, we're getting a little bit imbalanced here?
So it is about the CapEx cycle for sure, which is manifesting itself in incredible earnings, and at least that's what we saw in the first quarter, which mainly came from two levers. It came from AI and it came from energy. And the way in which to think about it is, for those advisors listening, is really telling your clients to move towards those durable growers. So think about the growth that you're seeing already in the CapEx cycle and optimize on that with an ETF like BlackRock AI, BAI, which we are seeing a lot of clients use to complement other non-AI exposure in their portfolio. And frankly, energy security, whether or not, hopefully we'll continue to get some positive headlines, but I think energy security will be with us for a while. And again, that is a great energy hedge in your portfolio as well as a durable theme in your portfolio.
In terms of just positioning, after Friday's sell-off, I'm sure there are a lot of inbound calls about, am I diversified? And so what do you advise people right now? Because I would imagine that there is some overlap in terms, especially if they're investing through ETFs that they don't even know about. They're invested in S&P 500, NASDAQ, even in certain energy ETFs where the story that's driving that ETF is still AI.
Absolutely. And I think we saw this in March. And of course, we saw that on the price action on Friday. I think what's very hurtful for clients and the incoming had been around, where do I source diversification? I think that's been the real challenge when stocks and bonds go in the same direction. And at least on Friday and in March, you didn't see your traditional diversifiers work either. This is where we've long held, especially in our advisor outlook, talked about the concept of diversify your diversifiers. So really thinking about what is it that you're trying to hedge? If you're trying to hedge inflation, let's look for inflation protection or a broad basket of commodities. Or actually, if you're trying to hedge the stock-bond correlation, look at ways of seeking absolute return with alternative strategies like the iShares Alternative ETF iAlt, which again, a lot of interest because it's giving you absolute return without that market beta.
You seem pretty skeptical that bonds, the old style, will continue to or resume their diversification impact.
I think that it depends on the shock that we're hedging for. If we are indeed in this recessionary, traditional risk-off with growth expectations going down to negative territory, I do think bonds will work. And especially when we're at the yields that we are at today, I think that obviously allows the Fed to cut rates and it allows long-end rates to go down. But that is not the risk we're hedging today. We're actually looking at a really powerful, resilient, AI-driven economy with inflation at 63 months running, not hitting the 2% target. And I think that is an environment where long duration becomes tougher. And we've seen investors continuously move to fixed income. In fact, May was one of the strongest months of ETF flows for fixed income, but they're keeping their duration in the shorter end of the curve, keeping it into inflation-linked bonds and seeking income.
And gold is still increasingly being used as a hedge in your portfolios.
It is very much so. We look at advisor portfolios, and one of the things that we find in our advisor portfolio insights is really that 12% of our advisors that are sharing data with us are using an increasing amount of gold as a geopolitical as well as an inflation hedge in their portfolio.